Ashika.
And I, Nitish Fadnis.
Would like to take the event further. So let's move forward with the second round. That will be the presentation round. The theme for this round is looking through the new lens, moving towards consumer centricity.
Consumer centricity requires that the innovator suspend their own assumptions, biases, desires, and calculations, and instead look at the problem from the lens of the target audience whom the innovation will impact and serve. By adopting a more human-centric approach, companies can remain agile in an unpredictable modern world.
We see the world not as it is, but as we are. So, as we are conditioned to see it. Breaking that prejudices, we will now be advancing towards round 2 of the discussion that will help us to see the world from a different lens.
In this round, industry experts from different backgrounds will discuss various strategies and new solutions.
The experts in the panel are Mr. Sanjay Datta from ICICI Lombard General Insurance Company Limited,
Mr. Shankar Gargiparthi from Lloyds India,
Mr. B.C. Patnaik from LIC of India,
Mr. T.A. Ramalingam from Bajaj Allianz General Insurance Company Limited,
Mr. Amit Mishra from the New India Insurance Company Limited.
We now request you, sir, the panelists to come on the stage and form the dais.
Give them
Welcome,
a big round
sir.
of applause, everyone.
Okay. Okay. Welcome, sir.
We now request our team to welcome our panelists with a floral bouquet. Welcome, sir, and thank you, my dear friends. Ladies and gentlemen, I now have the pleasure of inviting Mr. Sanjay Datta to make his presentation on the topic Innovative Products to Mitigate the Changing Risk Dynamics. But before that, let me take this opportunity to introduce Mr. Sanjay Datta. Mr. Datta is Chief of Underwriting, Reinsurance and Claims at ICICI Lombard General Insurance Company Limited. Sir was a part of startup team at ICICI Lombard in 2001 and has since then contributed to growing the business into a market leadership position. He is responsible for customer service for all the product lines of the business and spearhead risk management, underwriting discipline, product development, and pricing across wholesale and retail products. With this, sir, I request you to please come forward for your presentation. Let's give him a big round of applause.
Good afternoon. This is a post-lunch session. I wish I had a product to take care of post-lunch inertia, but I don't have any innovative product. So I'll talk about the, the whole landscape in terms of product which we currently have in India, and what we need to do to foster some kinds of innovation, what's happening any which way because of a lot of factors, ecosystem, the players in the system, as well as the customers where, who are changing a lot and, which leads to all of these products, getting developed. And finally, the most important, there is a changing nature of risk. The dynamics of risk are changing, and we need to take that into account when we look at products, which are designed to transfer risk, not only to us, but to a lot of other ecosystem players like the insurers who are behind us. It's working? just can you do this for me? Yeah. So, just to give you a small update on, where we are, because how innovation has started post, privatization of the insurance industry, 2001, a lot of changes have taken place. And one of the key things which is, followed, as regulatory changes were ushered in was de-tariffing. What was, the simple, that event which actually has fostered a lot of innovation, as we go forward. So the two things which we need to keep in mind are exposure-driven products, which are mostly the fire, engineering, marine kind of products, which can lead to severity claims, and the experience-rated products, which are health and motor primarily. And in these products, as we get a lot of claims experience, we need to then understand that and develop products as we go along. And what has happened, of course, there has been, de-tariffing has led to a lot of changes, not only in the way pricing has been done, the way we are looking at risk-based pricing as we go forward. We are looking at so many other dynamics about understanding risk as we, develop products. The other important change is, someone did talk of the fact that a lot of products are still, in terms of wordings, tariff. That has been one particular, feature of this market. It's not been bad. A lot of people say that it has its own, challenges, but in terms of customer differentiation, but it also has, in a nascent stage of the market, it brings a lot of simplicity to the way the products are sold. So hence, it's not a very bad thing. And finally, we have the currently, the whole talk around how products have been, in a sense, the product approval process had been deregulated. It started with, B2B use and file, and B2C, file and use. Now both are kind of being merged together. We have complete freedom to, as insurance companies, to be able to develop products and around various lines. So that's what I want to take you through as we go forward shortly. Can you move to the next line? Take motor insurance, which is one of the standard key products in the market in general insurance. It has various nuances as it goes forward. Obviously, we've come out of a third-party motor pool at the beginning of the earlier decade. That was a very seminal moment. It led to TP pricing, which has been the only product which is priced to be done on a particular risk-based approach, albeit by the regulator. But a lot of actuarial thought process, a lot of underwriting thought process in the way the the pricing is being developed. So which is a good thing forward as we have been able to stabilize on TP pricing over a long period of time. But if you look at the way the own damage product has kind of developed over a period of time, various add-ons have been bought into to take care of the normal base product. Now these add-ons have developed due to industry needs, and these industry needs and the customer needs which have come in, is very, very important as we go forward. They are something which has set us thinking in terms of product innovation, and some of these product innovations are something which I'll just talk about in the next section. Just move. Let's look at some of the practices which are currently there. You have model-based, location-based, and various other kind of architectures in terms of rating motor products. Look at the servicing architecture. It's mostly, let's take private car for example. Majority of insurance companies have a cashless setup for the entire servicing of the product. Now this has led to a lot of innovation in the way we service claims and also develop products to be able to help customers. The final, I've talked about the tariffs and the deductibles which have come in, in terms of products. But the one key change which has happened, and which is the regulatory change, which is the whole introduction of long-term products in third party, allows us, of course, that's something we are looking forward to even in own damage as we go forward. But let's look at the most important other factor which has started changing now. And this is important for us to look at innovations around the motor product. It is now moving to usage-based insurance. The regulators allowed floater, pay as you drive, pay how you drive kind of products, which is very, very good. It allows you to look at driving behavior as a very important factor in development of products. Now this will open up the number of factors which will be opened up is unthinkable. There are, the advanced markets like US has 500 factors. on which they rate motor insurance, starting from age, to the color of the car and various other elements. Now, this is something which will be a very exciting journey as we go forward. Of course, it means that we need to use data a lot. Data about consumer preferences, data about consumer driving, which is where telematics comes in very strongly. Some of this will be led by OEMs who will share data with us. Last but not the least, there is this brave new world of self-driving cars. I don't know how we will, as insurers, be able to rate them, be able to give covers for them, but that's something which is going to develop as we go forward. And finally, there is this whole thing around, integrating with the ecosystem. So there are so many government logistics systems, take Vahan, for example, where the insurers started integrating. We'll start integrating, understanding consumers, looking at various other aspects of logistics, and be able to develop products around them. So this is very, very exciting in the way the innovation is getting fostered. But the key important part is understanding consumer behavior, and B, the most important part is surrounding data which is emanating from consumer behavior. And that's pretty important for us to consider as we go forward on innovation around motor, specifically logistics. Now move forward to the next one. This is an example of a motor floater policy, which is a kind of a new, which is there in health, but floater in motor was a considerably new concept the regulators allowed us to put in, which basically says that you could bunch your motor cars together, two cars, a car and a two-wheeler, and whatnot. So the idea is to be able to give you a kind of, in a sense, a holistic solution to your logistics problems. Now, this is something which is very new. Added to that, you will have pay as you drive, pay how you drive, and you will have a whole new world of innovation around the motor product, which is there. And this, mind you, this is without de-tarification of TP. Once de-tarification of TP takes place, and a lot of innovations around TP take place, the world will open up into a very new, possibility on motor and, subsequent logistics. Why is logistics very important? Now they're becoming an important part of our supply chain management across the country. People look at logistics very strongly, not only in the commercial vehicle space, but even in the private car spaces as we start maneuvering around using different modes of transport and aligning, the motor vehicles along with that. Let's move to the next one. This is, in brief, what's happening in the environment on the health side. Now, I think the key takeaway is that insurers are now straddling across the various chains of the continuum of care, starting from, where we're looking at some tests. We've never covered those tests. We're looking at OPD consultation. There was, today's, I think, mental health day. A lot of our products don't, you never used to cover mental illnesses. Now they do get covered if you have outpatient treatment covered there. Of course, inpatient, not very many claims, but that's not the whole idea. The idea is to look at outpatient treatment more as a wellness and a preventive initiative, so that because mental health is connected to your, physical health in a very strong way. Now, this is evolution of the product as we go along. And coupled with that is again the whole story around how do we as insurers interact with the ecosystem. If we don't interact with the ecosystem, we'll never know how the entire data set for pricing and developing products will happen. But having said that, you all know that healthcare costs drive health insurance premiums. Our understanding of healthcare behavior, healthcare access, healthcare seeking behavior of consumers, what they value, what they don't value, what is preventive, what is curative, is very important. And all this comes from data sets as we want to look, go forward. These are data sets which are emerging in this field, and we are going to really look at some of these data sets as they emerge. Some of it will come straight from National Health Authorities initiatives. We're doing a lot of initiatives around electronic health records. Aadhaar records are now, each one of you are going to have your own health record like your Aadhaar card, which is going to be transferable. Now this is going to be important for us as we go and look at medically underwriting, customers. We're looking at difficult risk sets, which are known as, risks which we traditionally declined will now keep getting covered. There'll be a lot of primary care coverage. And finally, we are looking at measures of healthcare inflation, and how do we look at evidence-based medicines and value-based care. These are important elements which we'll need to factor in the product as we develop, wrap it around, the healthcare ecosystem, look at preferred providers, and be able to deliver products around these. So these are key important data set elements which we need to study and track as we develop products around this. Move forward to the next one. The last part is the commercial lines. There is a, there are two parts to this thing. Commercial lines, traditional commercial lines, and the one where there's a lot of emerging risks. Emerging risks could be, things like infectious diseases, cyber risks, which catches unawares. Now, in all of this, one of the key parts as we move forward is going to be, again, data. Our understanding of data is going to be extremely important as we develop price products, not only for the short term, maybe also for the long term. There's a lot of buzz in the market around long-term products. To do it in the commercial space is not easy because we are talking about severity claims which happen once in 10 years. You have 1 in 15 years kind of extreme rainfalls in certain urban locations, which we need to understand, be able to track. There'll be climate change, there'll be so much of accumulation studies. Pandemic, really, thankfully didn't, play out, too badly on the general insurance sector, apart from health insurance, or not on the commercial side, because our products didn't cater to business interruption due to pandemic. Had they catered to it, we would have had a significant loss in the market around that. Now, is there a need for such products? Of course there is. How do we create such products? It's easy to create them, but how do we get capacity? That's where I talked about ecosystem players behind us. We need to have a whole set of players, including reinsurers, who will be able to give us, a capacity to develop products around these lines, and that's something we need to look at. Lastly, on the product data sets. Can we move forward? Yeah, so these are the data sets which become extremely important to look at these various emerging risks which are there. Now we've been looking at risk inspection, some risk management solutions, loss prevention, loss minimization slowly started coming into the picture now. We have a lot of pool formation which is now getting actively carried out to bring in capacity. Sometimes when it is not available across the globe, we now started developing national pools. But the big thing going forward is going to be those risks which are difficult for us to look at. Understanding accumulation and being able to build capacities for one simple thing. In this line of products, sustainability of products and pricing is going to be extremely important. We can't have situations where we have a huge loss and stop the product altogether. And that's very important in the innovation process. We should build trust, we should have long-term products, but it should be sustainable, not only in terms of the way it is priced, the way it plays out in servicing. Finally, that's the last slide. So these are, I think customers, we have to engage with a different set of customers are coming in. And we need to engage with them in different ways to find. So there'll be people who are, if you look at retail customers, there'll be point of sale purchasers, there'll be, various kinds of, these are names which have cropped up in the ecosystem. I'm just borrowing that to be able to give it to you. There'll be people who look at data, who will be very happy to have insurance where you are able to price them on their data usage. I drive my car for 30 kilometers, I need to get a lower price every, compared to my neighbor who drives 100 kilometers. They are the guys who look at data and, look at their things. Similarly on their wellness and various other things. They will give you data and they ask you to develop products around it. And finally, in the small businesses, this is important that we develop bring penetration. The chairman talked about penetration. This is where the small businesses need to be covered. And that's where we look at various kinds of small businesses, not in the way we sell products, but also the way they look at risks and look at the way they are trying to develop their ecosystem. A lot of startup ecosystems are developing in the country. How do we cover them? What kind of products is going to be extremely important in the innovation game. Thank you. If there are questions, I can take them up later. Thank you very much for a patient hearing.
Thank you, sir. The next speaker for this session is Mr. Shankar Gargi-Parthi. Sir is the CEO and country manager for Lloyd's in India and has successfully established Lloyd's operations in India. Mr. Shankar has over 28 years of experience in the financial service sector, and not only he brings a unique blend of experience in regulatory and compliance, but also experience of setting up new entities in emerging jurisdiction. Prior to his role as CEO for Lloyd's India, he was the Regional Compliance Manager for Lloyd's Asia and Director of Insurance Supervision at the Qatar Financial Center Regulatory Authority. We would now like to call Mr. Shankar to the podium for his presentation on the topic, Role of Reinsurance in Enhancing Insurance Penetration. I request you, sir, to please come to the podium.
Good afternoon. Good afternoon, everybody. And again, apologies that this is a post-afternoon session and nothing worse than to talk about reinsurance and enhancing insurance penetration. So I'll try my level best to try and keep you awake. Hopefully you've had plenty of coffee. Thank you very much to the NIA, Mr. Srinivasan, Dr. Srivat Das, and also to the students. Thank you so much for inviting me to this session. It's a privilege to present some of the views and also contribute to the dossier. So I will apologize. There's a lot of very learned colleagues here and highly senior colleagues who understand reinsurance much better than I do. But I will try and, in my own way, one of the things that as a regulator in the past and also as compliance and industry professional, one of the things that I've been constantly banging on about is to simplify language, make things simple that any common man should be able to understand. When I go and sit in front of people and say, what's reinsurance, they all look with a big glaze. It's more glossy than all these chandeliers put together. So I'm just trying to make things very simple. So apologies if a lot of this comes out to be pure basics to all of you. So get yourself a cup of coffee if you really need to stay awake during this session. So what is reinsurance? Fundamentally, it's nothing but insurance of insurance. So essentially what it is that the insurance companies who assume your risk, your contract is with them, and they will sometimes find that the risk is too big for them to bear on their own balance sheets, and they will probably offset some of that risk to us as reinsurers, who are essentially trying to help them take that risk off their balance sheet. And in an exceptionally large risk, what will also happen is us reinsurers will also purchase reinsurance, and that is called a retrocession. And in very, very exceptionally large risks, the retrocessioners also will purchase reinsurance, and that is, again, is nothing but a retrocession again. So it just stays at retrocession. I don't think we found new words beyond that. But what's the role of reinsurance? I mean, again, I've listed a few that came to mind very quickly. The first and foremost is to provide capital relief for insurance companies, because when they offset that risk to us, that enables them to assume more risk. And it gives them that little bit of capital protection. The other biggest benefit that happens here is diversification of risk. So what you will also see is, let's say, and since Sanjay is here on the panel, and he's a good friend of mine, so I can always say, let's say ICICI Lombard takes on a risk. They find it too big, and they'll probably say, okay, what about let's find a panel of reinsurers who are actually going to try and help them reinsure that risk. Now, what typically we will do is we will not all take that risk 100%. We will all take shares of it. So let's say there's 10 of us who each take 10%. And the benefit there is diversification. Why diversification? So if any one of us gets into a problem, it is not going to be adversely impact the insurer in order for them to be able to recover from the reinsurance. So the more we diversify, the better, and that's one of the benefits of reinsurance. It also allows for improvement of capital allocation. So when they, for example, reinsure that risk out to a reinsurer, the insurance company is then able to deploy that capital that they've been able to free up from the reinsurance to implement it in other ways, that they can probably develop new products or new solutions, new technologies, etc., that they're able to do better. We also support with underwriting and claims experience. Most of the time, reinsurers, by virtue of the way we do business around the world, we've probably introduced new products, new solutions, etc., which we have probably worked out in other parts of the world. And I'm not saying it's one size fits all, but we've probably learned from those mistakes. And we're then able to bring that expertise locally, and who are then able to talk to the insurance companies and say, look, maybe you can, some of these wordings would help better structure the policy for you. And even when a claim occurs, the reinsurer typically would handhold the insurer to try and help them with the claims settlement, etc. New products. Again, Sanjay talked about innovative products, etc. Again, a lot of the new products are done with the help of reinsurers. Reinsurers bring, again, cyber, for example, is something that was done in the developed markets, developed markets quite a bit, and also now bringing into the developing markets, where the reinsurers actually bring in that expertise of writing it in the other markets. contribute to the growth of capital markets and invest in research for future readiness is something that, again, reinsurers are very good at. There is a lot of reinsurers who actually do thought leadership, be it cyber, be it climate change, ESG, etc., that people are talking about today. These are all things that reinsurers have probably come out many, many times in terms of their own thought leadership reports. Now, those kind of things are then again for the benefit of the local industry and local market in terms of how those studies can be used in order for you to develop your own thinking of products as well as knowledge locally. Your traditional reinsurers companies are basically your normal stock holding companies who actually sit and take the risk on themselves just like any other normal company that you've seen in terms of an insurance. But we're also seeing a lot of alternative risk transfer mechanisms that are also there. So this is typically what happened, particularly after the catastrophic events of 9/11. We've seen a lot of alternative risk capital that came into the market. Now, this is not your typical shareholding companies, but there are typically let's say your capital market investors who are also suddenly looking at saying, oh, here is an opportunity for us to get a return. Everybody's looking at a return on investment, right? So you have your shareholders who are kind of writing a traditional book of business, but then you have your alternative risk. And this is where people like capital markets are looking at issuing bonds, where they're saying that we will protect a certain catastrophic event that might happen. And in return for it, you get a coupon. And that's their interest that they get and the return they get. Industry loss warranties, again, you can kind of ring fence a certain portfolio of business and you try and see how much of that business can be written as an ILW. Collateralized reinsurance, I'm not going to read out all of this. This is all there for people to, I don't know if the slides are available later for people, but it's always there. But this is something that's coming up quite a bit. But I think one point which I want to mention from here is, during the course of the day, we've been talking about how insurance industry should come up with a lot of innovative products and innovative solutions. But I'm also thinking, maybe this is where even the regulator can come up with something like a portfolio loss transfer kind of company, a company that simply reinsures a loss transfer portfolio, a loss portfolio of an insurance company, and just takes it off their balance sheet. And what happens then is that the insurance company is able to then free up that portfolio because it's taking up it's draining their capital and resources in terms of servicing that particular portfolio. Why don't you just hive it off to a reinsurance company or a portfolio loss transfer, under a portfolio loss transfer, and these guys can actually manage that. And then that frees up your capital in order for you to develop new products, new solutions, and new client acquisition, etc. So what do we see as the current challenges in the current framework that we are seeing is we are actually being supervised in the same way as an insurance company. My policyholder is only the insurance company, which is in other words a sophisticated client. I don't have to deal with the retail policyholder which an insurance company typically has to deal with. So I am dealing with a sophisticated counterpart. So therefore my regulation should ideally be in a slightly different format and not as micromanaging as what an insurance company would do. You're also seeing that a lot of developing economies are looking to reduce the outflow. They always look at saying, oh, the money is leaving the country. But I would also say that there's claims being paid, so money is also coming back into the country, right? So it's not just money going out, money is also coming in. But the benefit that you're also getting is that the reinsurance industry is able to support the growth of the industry locally in terms of how to take on more risk. And in a country like India, where there's a lot of natural catastrophes that are happening, I mean, we're just standing here, I think Mumbai today has escaped the rains, but Delhi and every other part of India currently is having severe rains and flooding. And we don't have the right kind of infrastructure and insurance to actually support all the damage that we are facing on a day-to-day basis. The other big danger that we also have is risk concentration. The whole purpose of reinsurance is you're diversifying the risk. So if I'm then going to insure, let's say the policyholder insures their risk with the insurance company then reinsures it with the reinsurance company in India. Your money is invested by the insurance company in a capital market here. They pay their premium. I'm also required to invest the money into India itself. So tomorrow, let's say, God forsaken, something happens in India. We have a massive concentration of risk within India, and we don't have the benefit of diversification. So the whole point of reinsurance is you diversify your risk, you get the benefit of the fact that if something happens here, it's not going to adversely affect the reinsurer, who's able to still pay the claim because they've got the benefit of other investments that they've been able to do, and they're then supporting the local market as well. I think the restriction on free flow of capital also adversely impacts our ability to really support the economy at large. Because if I'm not able to invest that money elsewhere and deploy that capital elsewhere and also try and do more, you're then actually restricted in terms of what you're actually able to develop as a company, insurance company. So I think that is something that policymakers and lawmakers need to look at. There's another move that has been, that we see quite often by a lot of the developing regulators is where the insurer is the reinsurer is asked to basically book their business locally only. So as an example, Lloyd's has got a syndicate here. If the risk goes to my market in London, why can't I write that there? Because I'm able to better utilize my capital allocation, because at the end of the day, I'm always looking at it as a capital efficiency point of view. So I'm still supporting the market here, but I'm also able to get the benefit of my capital resources by booking it elsewhere. So, but by forcing me to do the business only locally, then that's a deterrent for me, because I'm not able to get the benefit of my capital efficiency in that regard. So these are just some of the challenges that we see. And I think my last point is, in terms of what do I see as the enablers. We're always talking about penalizing people for doing business, and I think that's something that we as international markets are seeing, that by coming to India, you are being penalized. There's a perception amongst the international community that, oh, if I come to India, I can't get the money out that easily, it's difficult, there's a burden of compliance, regulatory burden is too high, et cetera, et cetera. And then when you have all these kind of restrictive market practices that happen, it just makes it even more difficult to convince the other person that there is an opportunity here, you need to come and do business. So my way of looking at it is slightly the other way around. Forget about penalizing me for doing business. Why don't you create the framework of incentives for me to come and do business? I think Sanjay in Acadia mentioned in his presentation that about a third of the cross-border reinsurers left the country or stopped doing business with India. Why? Because they're able to see a better return of investment from another market. Never mind the fact that they've suffered losses in the same market, they're getting a better return. So if you take US as an example, Hurricane Ian is going on right now. The current estimate is $74 billion. Are you telling me that not one reinsurer is willing to reinsure that market again? They will fall over themselves to go and reinsure that market because they are able to get the return on investment. Here they find perception, again, is that they are not able to get that return on investment. So my point is, why don't you incentivize them? Give them some incentives in terms of setup costs. I'm not saying forever, for 2-3 years, it's that initial setup cost. My tax differential is very high. So I'm not able to compete on a level playing field with my local counterparts. So how do I actually bridge that gap? So training and development, we've got students here. Yes, somebody mentioned about the fact that let there be an internship program. But I'm also going to go one step further. So if, let's say, for example, I take on a bunch of students or staff locally, and I'm going to train them up on, let's say, trade credit insurance, which is one of the new products that is being promoted by IDA. If I'm going to invest in the training of that person, why can't I be subsidized for that person's training? And essentially what you're doing is you're minimizing my cost of doing business in the country. Because these incentives are there, and therefore I'm already being incentivized to come and do more business. Why do you think people go and set up in Singapore or Dubai or Hong Kong or wherever? Because they find there's no local market there. The market Whereas here, we have a local market here. India has got a huge market and a potential. But because of all these barriers that are there, people don't want to come here. That's my big question mark. I think the regulatory regime needs to be a little more efficient in order for us to be able to come and set up. I think the chairman made a reference earlier about the fact that he's looking to get more companies to come and set up. Let's have some service standards. You know, when a application is set up, submitted to the regulatory authority, 2 weeks, 3 weeks, approval is, you know, given. And let there be monitoring of that also, because that again puts a big report card, which people can see and people are able to say, this is actually a very efficient place to do business. The other big side, which one of the things that the chairman mentioned this morning is about, you know, he talked a lot about development, etc., with very little reference to compliance. If anything, it was all about ease of doing business and reducing compliance burden. But let there be a development arm that is actually out there understanding what the market is doing. So again, my point here is, we've got this wonderful event going on here. Where is the regulator? I'd like them to be here in the audience, listening to us, listening to the industry, deliberating these discussions and topics, wherein they're able to go away and say, okay, people are talking about surety bonds, people are talking about trade credit, people are talking about cyber. What is it that we need to do in terms of a developmental framework to enable this product to be developed in the country? And how do we actually go about it? And if there needs to be tax incentives, some other incentives that need to be done, what is it that can be done for the benefit of the industry? So that's again where I think, and again, the other point is size of the prize. We're all sitting here and going and saying, India is so good, we've grown X percent, Y percent, etc. But the international market is always going to look at it. The investor is going to say, what's the potential? What is the profitability of the market? I want to know that. And that's where I think the development arm will be an independent body that actually is able to not only support the industry, but also able to have a more meaningful dialogue with the regulators such that the development and the regulatory policies are aligned. I've talked about incentivization of doing business in the country. And I think the economic value of reinsurance and reinsurers lies in spreading and diversifying risk, which I think is fundamental. So finally, my last point here is, beneath the surface of complexity lies a fascinating business of reinsurance, which is characterized by a truly holistic perspective on the risk landscape of today and tomorrow. That's me.
Thank you so much, sir. The next speaker we would like to call upon is Mr. B.C. Patnaik. Mr. B.C. Patnaik has taken charge as Managing Director of LIC of India in October 2021. Sir joined LIC in 1986 as a direct recruit officer. Prior to taking charge as Managing Director, he was the Secretary General of Council for Insurance Ombudsman. In CIO, he introduced online hearings as well as online registrations of complaint. As Chief CRM, he played a pivotal role in introducing LIC's e-services and NASH mode of payment. He has rich and diverse experience in marketing, customer relationship management, underwriting, group business, personal and training. He has worked across the length and the breadth of the country. Today, he will be sharing his views on reaching the unreached, going beyond the traditional methods of distribution. Over to you, sir.
Thank you very much. When I see these young students, I get reminded of my younger days with a lot of idealism and fire for the insurance industry. So my fellow panelists on the dais, very distinguished members, Mr. Srinivasan, and Director NIA, Mr. Venugopal, Mr. Satyakumarji, and all leaders of industry, my colleagues, executive directors from LIC, members from the press, and also dear students from NIA. So it's a great occasion. I thank NIA for this opportunity. and a subject that has been given to me is very closer to my heart, because for the last 37 years or so, personally, and for the last 66 years, the Life Insurance Corporation of India has been doing its bit to reach to the unreached. How far we have been successful or not, time will tell. But yes, there is a lot of miles to cover in this journey. And I say that we are still on the job. And together with the support of all our sister life insurance companies, 23 of them, and many of them will be coming, and with a lot of support from brokers, banks and all, I think we'll be immensely successful, and we can fulfill the aspirations of the country, of the regulator, that by 2047, India will be a country which will be fully insured. Because I remember the former Finance Minister, Mr. Arun Jaitley, when he was telling that, yes, to be a developed country, India needs to be an insured society and a pension society. And the role of all the life insurance companies, along with the support of all other financial services companies in the country, they play a major role. And for the students, I can tell that it is exciting times ahead. They can look forward to a vibrant insurance industry. I can just, before I start the presentation, I can say that let me divide into three parts. Pre-1947 or 1956, nothing to talk about, though the fact was there were 243 insurance companies. But post-1956, when Life Insurance Corporation was nationalized, we found that the first steps towards reaching out geographically to the hinterland of the country started. And up till 1980, that means we found that a lot of offices were there in the state capitals. Then another phase was 1980 to 2000, when LIC really took off in the rural space, in the districts, in the small towns. And up till 2000, it could achieve around 10 crores of policies. That was a huge landmark, because all of us know that always the affordability was a big problem. So we first addressed the accessibility aspect. Then the affordability part was taken care of by the growing economic status of the country, particularly 90s to 2000. And 2000, with the support of the industry, a lot of private companies came. The life insurance business really took off. And life insurance also, from 2000 to 2022, with the help of technology, we could add another 3,000 offices to our existing branch offices and divisional offices. Plus, we had 40,000 sales and servicing points throughout the country, and many of them in very remote, inaccessible areas also. So that was a good thing that has happened. Now from 2022 to 2047, yes, I have some suggestions for the regulator, for the industry, for the government, by which we can make this dream a real success. Next. So this is how India has evolved since independence, 75 years. We can thank everybody that, okay, from a GDP of a very low of 2.7 lakh crores, it has risen to 197.5 lakh crore, and at present has crossed 200 lakh crores. And share in the world, which is 3%, it has become 8.3%, become the 5th largest economy in the world. Per capita income, you see, it was 274 rupees only. It was 1.26 as per dollar denominated rates in 2021, which has risen to around 160 odd. And population also 34 crore, 138 crore. So all this shows that, yes, there is huge opportunity in the life insurance space. Next. Sorry. So here we have a small thing like the growth of GDP, life insurance premium. You see, 1990 we have taken a base because it was 5,76,000 crore, and within 10 years we find it rose up to 21 lakh crores, and the huge growth, and the growth continues, and up to 2022 it is around 2,36,000 crores. What I want to say is that the life insurance premium also grew accordingly, and sometimes the growth was much, much higher than the GDP growth rate, except in a small blip for a 5-year period between 2010 to 2015 when a lot of products undergone change. But you see, when you see that it has really achieved around 3.2%, I don't want to compare with the generalist industry, but as Mr. Ritesh Kumar was telling, though from 0.5 to 1 it became, there was a 16% growth. But I see that the life insurance sector together, they have achieved significant growth during this period, and still there is a lot of opportunity. When you see the percentage growth that is the first premium income and the total life insurance premium, it is now at 6.28 lakh crores, which makes it around 3.2% of the GDP. Next, please. Sorry. So these are the GDP versus life insurance density. As we see per capita GDP, and yes, here there is a life insurance density. Today, Mr. Kumar was talking about it is 59 rupees, 59 US dollars, which is very, very low. Even if you take an exchange rate of 80 rupees, it's some 6,000 odd rupees. And yes, definitely the capacity is there in the country where an average can rise up to 10,000, 12,000 rupees. And most of the that missing middle we are talking about, where the average income has gone up to say around 5 to 6 lakhs rupees per year, there the premium can come up to 25, 30,000 for various other aspects of life insurance, not only to meet the death goals or the life insurance goals, but to also meet the life insurance lifetime needs. So now we talk about the unreached. So today, so here we find we have made it to small segments. These are workers in the unorganized and organized sector. Because organized sector, not everybody gets covered also, that we have observed. The small and marginal farmers, the SHGs and members enrolled in the SHGs, the building construction workers, which constitute a sizable section. We all enjoy the benefits of their hard work during day and during the night, but at the same time we find they're totally uninsured. Workers working for traders and small shopkeepers, that's a huge group. Going forward, we'll be looking to the statistics. The cross-selling, upselling for members earned under PMJJBY, we'll get the statistics. Around 10 crores people are covered. And CIT, this Confederation of All India Traders, around 25 crores people are covered. SHGs, as you have observed, around 8 crore people are covered. So here we see that what are the traditional methods of distribution? These are the individual agents, the corporate agents, the banks, the brokers, and the IMFs. Then supported by certain entities which are entitled to sell the microinsurance products. And they are the microinsurance agent, microfinance institutions, cooperative banks, regional rural banks, cooperative societies. Here, that means I want everybody to devote some time, so that's why I rushed through from the beginning. These are the perceived drawbacks for intermediaries operating under microinsurance regulations. So this is a drawback, perhaps, which is the reason for all this protection gap or not being able to reach to the unreached. I think Satya Kumar Jha sir will be agreeing with me because he's doing the research to how to engage this segment in a meaningful manner for the life insurance sector. Because it is very difficult, because life insurance or insurance per se is highly capital intensive. A lot of training is required, a lot of manpower required. I don't think there is substantial investment in manpower, technology, and training by all these microinsurance agencies who are involved in selling microinsurance. And I can say that perhaps the intent is lacking. Then the continuity of persons in systems, because all these industries, they are highly prone to attrition, and many of them do not find it very attractive, and the results, ROI, the results on investment of the time, their energy, and perhaps the attractive compensation structure that is not making this, because microinsurance products, the commissions are very, very less. And adequate volumes, if you do not get adequate volumes with the small ticket size, and also the low commission structure, I do not think how it will be scaled up by anybody. then and more, and what is happening is this particularly MFIs, RRBs, because they have to have a sustainable and a good performance in the core business. Because many of the MFIs, they are themselves stressed. They find it too difficult to manage their own affairs. How can they concentrate on the micro insurance part of it? So as we call it, something like lip service. That happens. I think many of my colleagues from the industry, they will be agreeing with me that it is not sustainable. Even if somebody succeeds in the first year, then there is no renewal in the second year. Next, sorry. And now we come to the aspirations of life insurance customers. Because we talk about protection gap, but what happens is that can only happen when I fulfill all my needs. When I do not have all the small luxuries of life, I just cannot think of a big insurance. Because in the priorities of needs, perhaps some other aspects, they precede in the order for the protection of the life insurance. Plus there will be a knowledge gap also. So even at the lowest level, they require some sort of returns to fulfill their need for a better living during their lifetimes. And also they require that, okay, if I put some money, at the end of the day, what is it for me? We're discussing since morning also that even if it is a term assurance also, people require that there should be a return of premium. Mr. Kannan was telling about it. So capital formation at the end of a determined period to take care of old age. And also to be part of a group to avail of benefits of group term insurance and group health insurance. So individual term assurance, whatever we may say, that will always be a challenge. That may be perhaps confined to 5% of the society, but 95% of the insurable population, they may be averse to some sort of individual term assurance because they have other aspirations in life. Yes, we suggest, in the morning we were discussing, Mr. Saurav Misra was telling, PMJGBY has been a success. So at present, though the figures differ, here it is 10.27 crores. Saurav Misra was telling about 29 crores. I immediately checked up. So it was along with the Suraksha Bima Yojana, which is at 15 rupees. And there was a paper which was telling out as 6.24 crores. So the numbers also vary, but let us go with 10.27 crores and accept that it's a huge success, 2 lakhs of insurance. Because in the individual space also we find that the average is less than 3 lakhs across the industry. So the entire life insurance industry has to feel that whether it is adequate or inadequate. But one good thing is there is a lot of scope. There is huge scope. Even if the endowment type is the ruling segment in the life insurance industry. In that segment also there is huge scope. I can put it in simple terms, like de-jargonizing all the concepts and making it an average of 10 lakhs. That makes it 7 lakhs if around 33 crore people are already insured or having an individual policy, multiply into 7 lakhs and multiply the average premium, and it's a huge business. Yes, PMJJY, it can be, that means scaled up nicely because a lot of new people have come into the insurance segment, and number of claimant 3.5 lakhs. And claim amount paid by the industry is 14,144 crore. So by any stretch of imagination, this is not a small amount because the industry otherwise in the individual segment, it pays around 42,000 crores. So whether this 14,000 crore is a part of it or not, I have to check up. But even if it is not part of it, so if there is 42,000 crore with so much of high insurance segment, 14,000 crore is a huge amount, and certainly it's a boost to the economy, it's a shot in the economy. What we suggest is still the premiums may be 425 rupees. Still many people in the country may find it very difficult. I suggest to make the penetration much more deeper. There can be a PMJJBY light. It can have a premium of 250 rupees and an insurance cover of 1 lakh. So I think we can discuss with the government and can make it possible. And I think all insurance companies will be comfortable with this amount. And there is a potential of enrolling another 10 crore members. Government with the existing scheme has a desire to enroll 15 crore members in total. But I think with this it can be faster. There is an SHG group. So we talk about SHGs because I remember I was once a manager of a group insurance. So that time there was a lot of schemes from the government. There was one called LALG, Landless Agricultural Group Insurance Program. So, I know that I was going to deep villages to see that the claims are settled. So that was in the 80s when insurance really took off in the social segment. Then there was a segment called the group insurance for the IRDP beneficiaries. So it started at a very low level of 5,000, 10,000, it went up to 30,000. But okay, now the banks are covering them in the PMJJBY. But SHG groups, somehow they are out of the ambit. Though they may be having a Jandan account, but perhaps I don't think we have covered a great deal of them. There are 8.58 crore members enrolled. And they are engaged also in economic activities as a group. They are taking loans from the banks as a group also. But yes, but they are at the lower segment, even a premium of something around 250 may be higher for them. But again, to start, we can have an annual premium of 150 rupees and insurance cover 50,000 rupees, which will be actually possible. And most of them are ladies, so ladies have a better, that means insurance component as far as the mortality is concerned. So I think this will be working out. And there is a potential of enrolling another 2 to 3 crore members in the PMJJY SHG. Here I was taking that we are so much focused on the rural areas that perhaps we forget that there is something called an urban poor. So it's my suggestion that it will be PMJJBY Urban Light. Let the PMJJBY name be a very brand name for all these social security schemes because it's well accepted. And there are various traders associations which can be allowed to act as microinsurance agents. And there is a confederation of all India traders with a very good website and everything. Anybody, if I am a trader, I can register myself for around 5,000 rupees. And I can suppose if there is something to be allowed, if I have 2-3 workers, and if I can pay some 500 rupees or per member 150 rupees, 200 rupees along with my annual membership fees, and I can give their details to them, they can be covered under PMJJBY Light. So these are totally uncovered. Perhaps I don't know why nobody bothers about them. Or I do not think they are also covered under the conventional insurance scheme. And whatever survey I made, I found that most of them today, if you don't pay 10,000 to 15,000 rupees, you are not able to get a person to be employed there. And I remember when I joined my organization, I was getting a salary of 2,000 rupees. But because, okay, you are belonging to the life insurance industry, you are managing a life insurance policy by spending 300 to 400 rupees out of that amount. So today, the cost of living may be higher, but somebody wants 10,000, 15,000 rupees. And I think he can certainly spare 500 to 1,000 rupees per month and can have a good insurance cover, which is the average life insurance that is available in the country today, around 2 to 3 lakhs of rupees. But perhaps the distribution models and others, why they are not able to accept it is, again, that means something to think about, or Mr. Satyar Kumar's research can also cover these aspects. So, and you see the number of traders, 7 crores. And yesterday I was reading it has risen to 8 crores every day. So here the figure is 25 crore, but they claim the figure is 45 crores. When we did some deep dive, they told now that means if I'm a trader, if my wife is helping me, I also register her name. If my son is that means 14 years, 18 years, whatever workable age, then I also register him as a member and I pay him some salary that gives me some tax breaks and others. So somehow it has risen to 45 crores. But 25 crores, some unique that is employees who are there with the 7 crore traders. So see the potential. With a little bit of regulatory support, governmental nudge, and the efforts by all the life insurance companies, there is a potential of enrolling 10 crore members. So it's just a question of looking to the direction of social insurance rather than what we can call commercial insurance, because any insurance company without profits, without reasonable amounts of premium from the main segment cannot survive itself, because there's so much cost in running an insurance company. But as C.K. Prahalad, to quote C.K. Prahalad, there is at the bottom of the pyramid there is some profits to be made, fortune at the bottom of the pyramid. So I think if you can engage this segment also, there is bound to be profitability and plus some social good. And as we observe from that earlier data regarding GDP growth and insurance growth, which comes faster we do not know, it is chicken or hen. But we can say that without GDP growth there cannot be insurance growth, and without insurance growth also there cannot be GDP growth. Because with more and more GDP, there are more and more risks. And to cover the risk, there has to be insurance. So this is how it operates. Yeah, this is building construction industry, 200 farms, 1,75,000 construction companies, 1,20,000 A-class contractors, 7.5 crore people engaged in the industry. There is RERA also, Real Estate Regulatory Authority. Yes, it can be mandated, because they have to renew their licenses and they have to say whether your people are insured or not. Let them act as a micro insurance agent also. I think in one fell swoop, perhaps more than 5 crore people can be also insured. Here, this is my take, that perhaps I don't think Panda Sahib is now not online, but message from the NIA can go to the regulator that we, for the micro insurance policies, we have limited to only a few entities and which have their own shortcomings. Yes, the available means of investing to achieve lifetime goals are in short supply in the country for the customers. Otherwise, you have cheat funds and other things, and they have their own delinquencies, financial inefficiencies. Here I find that there are 24 solid life insurance companies with 25 lakh individual agents and supported by nationalized bank, private banks, RRBs. And in the last 22 years, they have developed experience in selling life insurance products. Yes, they should be allowed to sell micro insurance products. So my suggestion is distribution of micro insurance products should be opened up for them, Venugopal sir. And they suggest product attributes should be conventional endowment type with sum assured ranging from 50,000 to 2 lakh as it is available in a micro product. And what I suggest more is there should be a 5-year renewable term insurance product covering life plus accident benefit plus PDB. This 1 year renewable term is very, very short, and that should be there. Thank you very much, sir. Thank you for the opportunity.
Thank you, sir. Continuing the interesting discussions forward, let me take this opportunity to introduce Mr. T. A. Ramalingam, sir. Sir is the Chief Technical Officer for Bajaj Allianz General Insurance Company and has recently completed 20 years in the organization. In his current role, he is responsible for managing motor and non-motor underwriting, claims, risk management, and reinsurance for the organization. Prior to this, he held the company's distribution channels and strategic tie-ups as Chief Distribution Officer for institutional sale. Sir has also guided and led teams to create efficient claim management processes that were critical enablers for delivering superior customer experience during claims. I would now request Sir to please come forward and share his views on service excellence, adding value to the customers.
Very good afternoon to all of you. And first of all, I would like to thank NIA for inviting me to this esteemed panel. And to talk about this topic on customer service, I think which is actually becoming a big topic, because I think we are a service industry, and this topic assumes a lot of importance because of the issues that customers face, be it on the policy front or on the claims front. I think if you look at the industry, maybe 30 years back or 40 years back, the focus on customer was not that great. It was indifferent. Basically because of the fact that in the initial days we were insuring mostly the fixed assets, be it the buildings, be it the factories or steel plants and things like that. And the retail business was yet to take shape. And I think it's only later on that we saw that the retail business started picking up. And I think many of you sitting here, I'm sure the people right at the back, the students may not be aware of the fact that maybe 20 years back, if you had a motor claim, it used to take nearly 60 days for settlement of the claim. And you're also required to deposit the salvage in the offices. So basically you need to get the vehicle repaired at the garage, and then the salvage has to be picked up and dropped into the offices. So if you were to walk into any of the insurance offices in those earlier days, you will find axle, bumper, and all those things lying in the offices, and you would wonder what are these things doing out here. I think in those days, I think the issue was about trust. I mean, did we trust the customers? And that issue comes up every now and then. Do we really trust our customers? If you see today also, I think if you ask any customer on the road about his experience with any claim, be it a motor insurance claim or a health insurance claim, is he happy with the insurance company? And I think 90% of the time people will say, I'm not very happy. Insurance company chore hai. Insurance company don't pay claims. That's the common perception about insurance companies. Nobody is happy with insurance claim settlement. And if you see the industry combined ratio is an average of 116, 117%, which means that for every 100 rupees that we are collecting, we are paying 117 rupees. But here the customers whom we serve, they say they are not happy because claims are not getting settled. Now this is a totally opposite situation where industry says that we are paying claims out of our pocket. Customers are not getting the kind of happiness when getting any claim. I think this goes on to show again the trust factor. I mean, do customers trust insurance companies? And what is it that companies can do to bring about that transparency? And that's where I think the customer centricity or the customer satisfaction part started taking shape. And I think if you see in the last 10 to 14 years, things have really changed, especially in the industry, in the insurance industry. If we look at today, the customer want a lot of information on the fingertips. He wants claims information on the fly, which I think over a period of time the industry has been able to bring about. I think to look at how the customer has evolved, I would like to take you to this customer behavior. So if you see today, I think the social media, the people, the youngsters, and even the people at the middle age have actually picked on to the internet. Everything is available on the Google. And today, people's awareness about anything has gone up. Now, along with that, today you have the e-commerce companies giving exceptionally great customer service to all of us. And that's actually putting additional pressure on insurance companies to see if an Amazon or a Flipkart can do something within 5 minutes. Why you guys take 5 days or 10 days to do a particular thing? I think that's what is trying to put pressure on insurance companies, and that's where if you see the kind of searches customers are doing on the internet, a lot of people, 50% of the people are talking about insurance. And I think that's where the overall understanding, the awareness of insurance has gone up in the last, maybe I would say 5 to 10 years. And here is the as you can see on the screen, the proof of that. Then again, we look at the millennial mindset. I think all the youngsters are all the time on the mobile phones. Customers want a lot of information on their mobile phones. Gone are the days when information used to be available on a desktop or a laptop or an iPad. I think today every customer wants all the information available here, because everyone is now working on app, be it the e-commerce companies, be it insurance companies, be it the food delivery guys, everybody is talking about app. And that's, as you can see, the penetration of the mobile phone is actually gone up year on year, and that's what is actually driving this particular change. And even if you see, that's also giving more awareness to the baby boomers, as we call it, the people who were born between 1945 to 1965, basically after the World War II. They're also becoming more and more aware of all these things, because their children or their grandchildren are actually teaching them all about what is available on the net and how you can source these things. That's what is actually pushing insurance companies to look at new ways and means how you can enhance the customer experience. I think a couple of things that we have tried and tested, which have been very successful. I think one of the things that has come as a big surprise for all of us is that while we feel that it's the urbanites who have access to internet, access to Google, have got cheap broadband and availability of all these things, you'll be surprised to know that even today the likes of Amazon and Flipkart nearly sell 40 to 50% of their things in the rural areas. And again, with that thought in mind, we thought, why don't we try out something in the rural space to see if it really works? And that's actually what brought us to this particular thing, which is called as the Farm Mitra. Now, this is basically an agriculture app. So when we were doing the agriculture business, how do we reach out to various people to tell them about the weather patterns, to talk about what kind of markets are there, and these kind of information, how do we disseminate to them? The biggest thing what we found out of this is that all the claims can be lodged through this app. And today, if you see this app, it has got more than 5 lakh downloads, even which our own company's standard, the retail app, doesn't have that kind of a download, because that has got only around 60, 70,000 kind of downloads. This has got more than 4 to 5 lakh kind of downloads. So this actually broke us the myth that rural areas where we felt that the farmers may not be having much of idea of how to handle the internet or the mobile apps. This particular actually broke us the myth, and this actually has got international accolades also, because this is the first of its type, and this has been actually a very successful experiment for us. Similarly, you look at our own Caring Leo's app, where we have given all the features. There are 32 plus features available for customers, be it their policy issuance, endorsements, change of name, anything. So today, what happened is that you don't have to come to a branch to get all these things done. Now, one of the things which has actually happened, which speeded up the entire digitization space, is the COVID. I think while on the one side, we as an industry are cribbing that COVID gave us a lot of health insurance claims. The losses were in excess of 28,000 crore for the industry as a whole. But I think on the brighter side, what I would say is that adoption of digital apps, which used to be around 40%, has today touched 92 to 93%. Because people were not allowed to, nobody was there in the office to attend to any of the, be the customers or the agents, and people had no other way but to adopt to technology. And I think that's where I would say the COVID actually helped us in actually leapfrogging from where we were. It would have, if the COVID had not happened, maybe it would have taken nearly 3 to 4 years to reach the position where we are today. And today customers are much more comfortable doing all the things on their app. And I think this is a prime example of what we have done. I think all of the companies in the industry have done something similar to this, and they're also reaping benefits of this. Similarly, one of the things during the issue or the problem statement we always felt in case of any kind of health claims is the discharge, because the problem is the patient is ready to get discharged, but the paperwork and the time that it takes is humongous. So basically, the patient may be told that in the morning that you will be discharged, but by the time he actually gets discharged, it's already 5 o'clock. So I think that's where it was felt that why don't we keep some person out there in the hospital who can actually assist in all the formalities that needs to be done. And that's where we felt that the customer also felt very, very happy, and he actually spread through the word of mouth. Now come COVID, again this problem came in where we could not put people in the hospital because nobody was allowed to be there. And that's where we also came out with the concept of this virtual RM or the virtual relationship manager. Again, that has worked wonders because today all of us do a lot of things through video conferencing, the MS Teams or the Zoom. Everybody is aware of it and the way the things are actually simplified. And I think that's the example of how you can marry technology with your services to give the best of the experience for the customers. And I think last but not the least, talk about the doctor on call. I think this is one issue everyone in the industry started doing it. COVID taught us this, that if there is any person who is having any kind of illness or sickness, the best way is to do a video conferencing, and through that we were able to get through in the initial 1 to 2 years. And even today, I think people are using this services to the maximum possible extent because they feel that this is an easier way, because I don't want to travel maybe 5 kilometers or 10 kilometers to the doctor's place. Sitting at my home, I can get the best of services. So what I would wanted to say is that as an industry, we have evolved. There is a lot we can do. We need to emulate the way Amazon or Flipkart is working, and we should be better than them. And the whole idea is that how we can give the best of the experience to our customers to whom we were indifferent maybe 20, 25 years. But today, I think as an industry, every customer is treated as a gold mine, and I'm sure that the way forward is a great experience that customers are waiting for. Thank you very much.
Thank you, sir. Next, we would like to call upon Mr. Amit Mishra. Mr. Amit Mishra joined as a AAO trainee Mumbai in the year 1987. Since then, sir has worked in various capacities at the operating as well as controlling offices at Kanpur, Bareilly, Delhi, Kolkata, and overseas at Trinidad and Tobago. Presently, he is looking after Motor TP hubs, corporate legal, research and development, and enterprise risk management as general manager at the New India Assurance Company Limited. Sir will be presenting on the topic Customer Engagement, Global Best Practices. With this, sir, I request you to please come on the podium.
Good afternoon. My esteemed colleagues on the dais, Mr. Srinivasan, students here, and ladies and gentlemen. In fact, when I was asked to share my thoughts on the topic, the initial suggestion was that it should be the way forward, because whatever you have been hearing since morning, that is in a way elaboration on what our regulator wants, what the ministry wants. My colleagues here have shared their thoughts on their respective areas. So I'll just try to put it together and perhaps try to look at, So in this presentation, I'd like to cover what exactly I'm thinking about the customer centricity, what has been our approach so far, and what is the expected approach as coming out through the presentations and whatever we are hearing since morning. Why do we need it? What it means for us? What role technology is going to play? And what are going to be the digital enablers?
So when we talk of customer centricity, uh, basically, again, as you can see in that graph, customer is at the center of our operations rather than our systems and procedures. We are trying to understand what exactly is it that needs to, what we are offering at present, and what is it that needs to fill the gap between his expectations. It is providing a positive customer experience, and when we are talking of product here, it is not just the insurance product. It is an augmented product which includes all the service related aspects. So what exactly is the way he wants his things to, not only what is to be delivered, but how it is to be delivered, which also remains a part of the product, which we are going to consider in our centricity. At present, what we have a customer-driven, policy-driven approach, where we expect, we produce some set of document, okay, this is our policy, and this is what you have to accept. Against that, and when it becomes a customer-centric, then industry will be expected to understand what the customer needs and adopt itself. We have been talking about reaching the expectation level, so there is a low level of market fit because number of players, restriction on entry, restriction on number of players, there will be low entry barriers. There is more cash burn now because of the products that are being offered, they are not meeting customer expectations. So obviously there is less intake, policies are being produced, cost is being incurred, but there are not enough buyers for those. If we produce the products which customer wants, they'll become more sustainable. And again, if the product is being introduced without having done the proper research about what the customer wants, there are chances of product failing. Even now, when I talk of, say, New India, or in fact, general insurance companies, especially those with 80, 90 years kind of history, they are having 100 plus products. But out of those 100 plus products, not more than 20% will be selling 98%, will be covering 98% of their portfolio. Remaining, they just remain on the shelf. That is because they are yet to meet the gap between what customer wants and what is available. So we have seen why we need this thing. Last 2-3 years have brought this position before us. What exactly was the customer expecting from us to deliver, the kind of risks that they are getting exposed to, and what was on offer. So companies have evolved there. In fact, you must be somewhat aware about what is happening in Indian market. And before coming to India for last 5 years, I was in a different market where the kind of ecosystem resembled somewhat similar to what the regulator wants to resemble here. So there were very little entry barriers, very little changes on restrictions, I would say, on affecting changes in the policy, pricing wise, product changes wise, all those restrictions were not there. What Mr. Shankar suggested about reinsurance, we could see that in those markets, reinsurance played a very big part. In fact, they were the ones who were able to suggest what kind of wordings we should consider, what kind of wording we should avoid. And in terms of introducing new product, again, their input was very critical. For initial years, we tried some products, and say the insurance company would take just nominal share, 1 or 2%, and slowly as our knowledge with the product grew, then we started taking more share. And that is the kind of system that is going to happen if you have to think of bringing more and more products. Because you need money power, you also need technical expertise, and on these, reinsurers are able to give very good input. So, this is how we look at when customer centricity increases, then how we are expecting it to affect the insurance penetration. Because penetration is low, we have been talking that it is just less than 1% for general insurance companies. It is because our products are not meeting right now. So you see, India stands at 3.8%, which includes life products. And when we are talking again general, less than 1%. Against global average of 7.2%, and in more emerged markets, it is in excess of 12%. Again, as the term was used today, we need a UPI movement for insurance also. So, in UPI, you all are aware that in last 4 to 5 years, the leap that India has taken surpasses most other countries, many developed countries also. Something similar is possible for us also, which we have to think about and work for. How do we achieve that? That has to be done by technologies. So, what it means for us, for insurers in general, that is customized packages, integrating insurance into multiple aspects of their needs, customers' needs. We expect our customers to become our marketing force. That, as you will see in those who are in the field, they know that good claim settlement is one of your biggest advertisement. A satisfied customer is your best marketing person. So, in terms of reviewing our product, in terms of reviewing the kind of service that we are able to offer, this is what we mean by customer centricity giving us the competitive advantage. Communication, we have been talking about that. Again, digital experience has to be the enabler. No. So, how it travels in from zero level to the topmost level, we start by understanding the requirements of the customer. Again, you have heard that there are different segments, so every segment will have their own requirements, their own specific needs. That kind of analysis will be required. Based on the needs of that particular segment, there will be offerings which will be suited to their own position, their own situation. With this specific group, there will be again customization as to what is to be offered and in what way to be offered. There are different ways of distribution channels. You would have, that also has got discussed today since morning. So, which model to choose to deliver the particular product to each group, and on completion of delivery of the product, then what is the experience, to gather the knowledge, to gather the experience as to what has been their experience, what has worked with them, what has not worked with them. All these aspects remain crucial. Especially this communication has been touched. Communication remains very crucial at entire stage of service delivery, from pre-sale to post-claim settlement. there only you gather the knowledge as to what more needs to be done to make it more and more suitable for our customer. This remains one of the most critical areas, and again, with the success shown by India in other BFSI sectors, it is possible that it will remain not confined not only to B and FS, it will also get extended to insurance. So there's a analytics revolution, cloud computing, digital evolution, high customization, again multi-channel customer experience, which you have said, and availability on social media to make it aware, to share what is being offered. Again, millennials are there, so obviously response time has to be shorter. Plus, now that industry is working towards some simplified products. Simplified products means minimum maybe 1 or 2 touch and product should be available. That is going to cater to the unbanked, those sectors which have not been covered, and to cover the basic requirements of those sections. Data analysis, data capturing and data analysis, which again will lead us to segmentation, finding the requirement, serving those requirements, and doing a continuous gap analysis. So with these changes, what we'll be doing, we'll be changing the existing legacy systems where certain products are available, take it on, and rather than moving from the mindset of take it and leave it, we'll be moving to what the customer needs and delivers it. What are the digital enablers? We just broadly we touched. So it is customer understanding, customer oriented offering. Within these segments, these are the different options. There will be social media, mobility, and when we go to last, that is customer experience management, we'll be using social media, mobility tools, digital marketing, and analytics. With this, I conclude my presentation. Thank you.
Thank you so much, sir.
So ladies and gentlemen, we have come to the end of the session, and what an insightful session it has been. In the interest of time, we are not having question and answers right now. With this, I request Mr. Ranjit Gangadharan sir, Chair Professor, General Insurance, to kindly help us to facilitate our panelists with a memento as a token of our gratitude and appreciation. Over to you, sir. Thank you, sir. Thank you, experts.